Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Veritone Inc. And let me tell you, this one has a little drama. It involves a company asking its lenders for a get out of jail free card. Intrigued? Let's get started. Veritone filed a report with the Securities and Exchange Commission, the SEC. These reports tell investors about major events at a company. This particular filing is called an 8K, and it's basically an ROO moment for the company. The date of the report is March 13, 2025. This means the events described in the report happened on or around that day. It's like a snapshot in time. Here's the headline: Veritone got a limited consent from its lenders. Basically, they had to ask for permission to deliver financial statements that might not be up to snuff. Think of it as asking your teacher for an extension on your homework and admitting it might not be perfect. This limited consent relates to something called a credit agreement. This is a deal Veritone made with lenders back in December 2023, where they got a loan. Now they're tweaking the agreement a bit. Veritone needed a waiver because their audited financial statements for the year ending December 31, 2024 might have some issues. Specifically, the report from their auditors might not be unqualified as to going concern. In plain English, it means there's some doubt about whether Veritone can continue as a business. That is to say, it might go bankrupt. The original agreement, specifically section 5.1c, required an unqualified audit opinion. This means the auditors have no major concerns about the company's ability to continue operating. Because Veritone didn't think they could get an unqualified report, they asked for permission, a consent from the lenders to deliver a report that says, we are not 100% sure they will stay in business. Here's the kicker. To get this limited consent, Veritone had to pay the lenders $1 million. Ouch, that's not cheap. Think of it as a penalty for not meeting the original agreement's requirements. It's like paying extra for a last-minute flight. The document includes an exhibit, which is basically an attachment. This exhibit is the actual limited consent agreement, and it spells out all the details we just discussed. This exhibit provides the exact terms of the limited consent, which are legally binding, and now let's analyze what this means for Veritone. This filing tells us that Veritone is having financial difficulties and is trying to buy time by requesting a bailout. This bailout is the limited consent. They need this permission because the report might say that they might not be able to continue as a business. And this is obviously not a good sign. Companies in good position do not need to ask for this type of thing, and they certainly do not need to ask for this type of thing, and they certainly do not need to pay $1 million to do it. This is a big red flag for investors. It raises questions about their ability to meet future obligations and potentially continue as a business. It means that they will have to find new ways to generate more money or significantly decrease their debt. If they fail to do so, they might go bankrupt. So Veritone is in a tough spot. They had to pay $1 million just to get their lenders to accept a potentially bad financial report. This suggests they are struggling financially. While it doesn't guarantee that the company is in trouble, it raises serious concerns for investors. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. Stay tuned for our next video where we will continue to explore the world of finance.